What's up, guys? I'm Jeff Montgomery and welcome to Tax Planning on the Whiteboard. Today we're going to talk about the 4 tax buckets and why tax diversification is so important. Just a reminder, if you like what you hear and you want more whiteboard videos, just click on that subscribe button. Quick disclaimer, this is not specific information to anyone watching the video. I want you to use this as general information and education only. Please don't implement any strategies you might see or hear on this video without talking to your financial professional or tax professional first. Okay, now that we got that out of the way, let's go to the whiteboard. Let's talk about the retirement account conundrum and why tax diversification is so important. If all of your retirement assets are in qualified plans like 401ks or traditional IRAs, you may have a significant tax liability on distributions when you retire. But if all your accounts incur tax liabilities before retirement, the erosion of your assets due to taxes may limit the growth potential of those assets. So tax diversification is a strategy of spreading your assets across a mix of taxable, tax-deferred, and tax-free accounts in order to avoid both of these scenarios. So on our whiteboard presentation today, we're going to see a sketch of the 4 tax buckets and explain a little bit about each one. Okay, so let's go to the whiteboard. The 4 tax buckets. What are they? How is our money taxed? And when we put the money in and when we take the money back out, what are the tax implications on those decisions as well? So the 4 tax buckets look like this. By the way, if you would like a handout on the 4 tax buckets, just send us a quick email. We'll be glad to send that to you. So the 4 tax buckets are: number 1, we are going to talk about the taxed now bucket, okay? So this is taxed now. I'll explain in a little bit what that means, okay? The next bucket is taxed later. So we have taxed later. Apologize, I'm not the best artist here. Then we have the tax-free bucket. That's interesting. Tax-free bucket. And then we have the income tax-free and estate tax-free bucket. So these are our 4 buckets. Now, let's explain the type of investments and the investment vehicles that are in each one of these buckets. So let's just take the taxed now bucket. So the taxed now bucket, most people are familiar with this, although you may not call it a tax now bucket, but typically this is going to be things like interest from a savings account or a CD, let's say CD, bank savings, something like that. You're going to receive interest from these accounts and you'll have to pay taxes on it. It could be a brokerage account where you're getting dividends and interest maybe on some bonds, something like that, in a brokerage account, in a non-IRA brokerage account. It could be capital gains. You could have some capital gains where they are being passed through to you, maybe through a mutual fund manager selling positions within the mutual fund, again, outside of an IRA account, or you're actually selling positions inside a brokerage account and realizing a capital gain. And it could be reinvested dividends, okay? So we talked about dividends up top, but reinvested dividends are also going to be taxable, and you will receive those on a 1099 form at the end of the year. And that's really the key with this tax bucket. You get this nice little love letter from the financial institution every single year, and it's called a 1099, and you have to pay taxes on the interest and dividends and any capital gains shown on that 1099 in the year that they occurred. Okay, That's the tax now bucket. Pretty self-explanatory. Let's talk about the tax later bucket. So what does a taxed later bucket mean? What's another word for taxed later? It's called tax deferred. So tax deferred are things typically that you know very well. As a matter of fact, I would guess that most Americans' wealth is located in this bucket. So these are traditional IRA accounts. Traditional IRAs. It's going to be 401ks, and we're going to talk about the traditional side of 401ks. Many 401ks have Roth options now. We'll get into that in a second. It could be a 457B plan. This is typically a state worker. It could be a 403B plan. This is typically teachers and nurses and doctors, maybe nonprofit institutions. It could also be qualified and non-qualified annuities, okay? Annuities, whether they're qualified as far as already in a tax-deferred situation, or a non-qualified annuity will grow tax-deferred until the money is taken out. So those are some things that are in the taxed later bucket. Now this bucket is extremely important because on most of these products, traditional IRAs or vehicles I should say, traditional IRAs, 401ks, 457s, 403bs, in most circumstances we're going to take out the scenario if you're still working, but in most scenarios we have a required minimum distribution, commonly called a RMD. I've also seen it called a MRD, so they're interchangeable. Minimum retirement distribution or required minimum distribution, minimum required distribution or required minimum distribution. Again, those are interchangeable. I've seen those both ways. But the magic age when you have to start taking money out of those accounts, for the most part, again, could be some exceptions if you're still working and contributing to a 401k, is age 72. So at age 72, under current law, there's talk about even changing this. It was changed recently from 70 and a half to 72. It could change again, but right now, under current law, it is age 72. And you're going to get a knock on your door, not literally, but you'll get a knock on the door by the IRS, and you're going to have to start taking money out of these accounts and pay taxes. It's a minimum distribution, and for most folks, it's going to be based on the Uniform Life Table, and you can look that up on any IRS site on the web. Now, let's go to the tax-free bucket, okay? The tax-free bucket sounds really good, right? It's like, why doesn't everybody do the tax-free bucket? Well, it wasn't always available. It was, I can't exactly remember the year they came out, but mainly we're talking about the Roth IRA, okay? So the money goes into this account after tax. You've already paid the tax on it. There are Roth 401k options now. We'll go ahead and write that down. Check with your plan administrator, see if you can contribute to a Roth 401k. Side note here on the Roth 401k, if a company does match those contributions, they cannot put those contributions in the Roth side. It has to go into the traditional 401k side. But your contributions could go into the Roth 401k side. You could also possibly throw in some municipal bonds here, okay? Municipal bonds, and of course, life insurance. And we're going to really talk about income tax-free on life insurance as far as the death benefit goes. And we could also really talk about appreciation on capital assets. And what we're talking about there is really the step up in basis in death. So it's not technically tax-free for you, but if you passed away and had capital gains in let's say a stock or even a home, and you pass that on, the heirs could get, under current law, a step up in basis. So that's tax-free. Some interesting things right now, again, under current law, the Roth IRA is the #1 vehicle that we talk about with a tax-free or the tax-free bucket. There are no RMDs, okay? No RMDs under current law for a Roth IRA. And that's very important. That could be changed. And you might wonder, why would the government ever change and require you to take money out of a Roth IRA? There's no taxes due when you take money out of a Roth IRA. But they may do that and say, hey, who knows, if you take it out, you might spend it. It might help out the economy. So we've seen, I guess, some suggestions in the past that that could be something that they look at in the future as far as any tax changes. Okay. Now let's talk about the tax-free and the estate tax-free. So more specifically, really income tax-free and estate tax-free bucket. And the main vehicle that we're going to talk about here is called the ILIT. And that's an acronym for a irrevocable life insurance trust. So let's spend a little time and understand a little bit more about this fourth tax bucket, because a lot of folks don't think about this. And let's face it, right now we have a very high estate tax exemption. Who knows? That could also change in the future. So let's dive into this one in a little bit more specifics. Okay, bucket number 4 is essentially for estate planning. Federal gift taxes and estate taxes are now integrated into one unified tax credit, which means that any gift tax exemptions you use during your lifetime will reduce the estate tax exemption available upon your death. The estate tax rate is 40% on assets over $12,060,000 in 2022. Currently, you may make a gift up to $16,000 to an individual family member or anybody without triggering any tax consequences. So again, an ILIT stands for an irrevocable life insurance trust and can be used to reposition assets from bucket 1, the taxable bucket, to bucket 4, the income and estate tax-free bucket. Part of your annual exclusion, you can transfer assets to the ILIT that will be used to purchase premiums of a life insurance policy. If structured properly, the life insurance death proceeds will be both income tax-free and estate tax-free. Proper use of an ILIT and gifting would allow you to leverage annual $16,000 gifts into the ILIT, and those would become tax-free and income tax-free and estate tax-free upon your death. So understand how that works. It's very important to make sure the trust is drafted properly and funded properly. Your loved one should receive all the life insurance proceeds undiminished by both income and estate taxes. Because an ILIT must be irrevocable, once you sign the trust agreement, you can't change the terms. You must give up control of the irrevocable life insurance assets. You must choose someone other than yourself to be the trustee, and you cannot be the beneficiary of the trust. Contributions to the irrevocable life insurance trust represent a gift because you cannot reclaim your contributions or receive any benefit from the trust. It would be inappropriate to use the funds that you are planning to use for retirement. It's especially advisable to consult with an estate planning attorney when setting up an irrevocable life insurance trust. Talk to your financial professional and talk to a well-qualified estate planning attorney, but we think that's something that you should pay attention to. So that's it for this episode of Tax Planning on the Whiteboard. Again, if you like these videos and you want to see more, click that subscribe button. I'm Jeff Montgomery, and we'll see you next time.